Hey Millennials, hey Gen Zers, listen up because this video is just for you. So is it possible to invest too aggressively for young investors? Let's get into that. Hey, if we haven't met yet, my name is Mitch Goldberg. I'm a financial advisor and a business owner. The reason, by the way, that I always throw out there, and I'm a business owner, is because I want business owners to know that I understand you. I too am a business owner. It takes one to know one. No one I see is talking about investing aggressively for people who are young. And when I say young, I don't want to exclude a lot of people hurting your feelings, but when I say young, I'm going to say 40 and under, okay? Is that okay? So nobody's really insulted? Hey, listen, I'm a Gen Xer, so when somebody doesn't consider me young, that's okay. I'm young at heart. How do you define an aggressive investment? That's the problem. When you say aggressive investment, you ask 10 people what an aggressive investment is, and you could easily get 10 different answers. I'm going to say your small cap stocks, your emerging market stocks or ETFs, okay? Even all large cap stocks. If you're 100% invested in stocks, generally speaking, you are considered an aggressive investor. And then where you take it from there is you just let it ride. Hold on for the long term. Don't get fancy with it. Don't get cute. Don't think, hey, I'm going to trade in and out, and when the next major bear market comes along, I'm going to invest all in. The fact is, I have met very few people who are good enough to time those kinds of dramatic market moves. And even if you do get it right, it's a different story to actually have the courage to invest when it looks like the world, financially anyway, is falling apart. Now, what I'm about to tell you might seem totally counterintuitive, but for you, when you're investing and you're young and you've got 20, 30, 40 years until your retirement, a bear market is your friend. A severely crushed down market, that's what you want, because that's when you get to buy stocks cheap, you get to reinvest dividends and interest from mutual funds and ETFs, and that's really the way you can possibly supercharge your investments by buying when things are when stocks are so low in price. What I'm hoping to see young investors do is go aggressive, be all in on stocks. You could diversify in terms of stocks, small cap stocks, mid cap stocks, international stocks. By the way, diversification is not a foolproof way to prevent you from losing money in the market, because in a generally down stock market, you're going to lose. Your accounts are going down. Diversification is simply a method that investors use to help reduce risk over the long term. As you get older, it's okay to start to switch into a more conservative asset allocation. Maybe at some point you're going to say, hey, you know what? Maybe I need to put 10% of my money into a bond fund, or 10% of your 401k plan into a bond fund, 90% stocks, and gradually move that number down as you get older. But to actually do that when you're 25 or 35, again, like I said, even 40 years old, I don't think it makes sense to do it. I think you should be aggressive, because you're not going to touch the money for 20 years or more anyway, and in some cases, 40 years. The key is that when you are a younger investor and you have a lot of time ahead of you, you can afford to take a risk on these kinds of investments. And the fact is, time, you know what, in investing, time doesn't heal all wounds, but if you do it in a diversified way, time does heal pretty much most wounds. Aggressive investments, because of their volatile nature, actually have more potential to grow over time, more so than stable investments. So you're compensated for volatility over time, but the key is over time. Over the short term, who knows what stocks are going to do? But over the long term, that's when I feel confident saying to my younger clients, stick with stocks for the long term, because that's where I think you're going to get the best return. Thanks for watching. I hope this video helps you out. For more information, please check out our website, clientfirststrategy.com. Please give it a thumbs up, smash that subscribe button, hit the notification bell. Thanks so much for watching, and I'll see you next time.